As the wildfires rage on in California, a wealthy investor traded $75 million to capitalize on this disaster to try to make more money in the stock market. So, to level the playing field for all of us, we will be analyzing this unusual option activity that could be what we like to call the Wildfire Investment Opportunity. Recently, Sempra, an energy infrastructure company providing electric and natural gas utilities, found itself at the center of significant market turbulence. As you can see here from the charts, following the devastating wildfires in California, Sempra Energy stock, ticker symbol SRE, took a sharp downturn, reflecting the immediate impact of this natural disaster on the company. But amidst the chaos, a wealthy investor is trading $75 million in SRE options. This massive investment during a period of uncertainty raises several questions. What prompted such a significant move? Is this a sign of insider confidence? Strategic positioning? Could this just be a technical trade? Because as you can see here, we are now trading at this very key support level where we bounced up last year. Or is this something else entirely? Let us know in the comments below. What do you think? Now, let's take a deeper look at this unusual option activity. As we can see here on the options time and sales tape, on the last trading day, January 13, at 10:45 a.m., 10,000 contracts were being traded for these April 17 options at the 95 strike call, 85 strike call, and the 75 strike puts. Now notice that this was a spread, so this was a trade being done simultaneously as a option strategy. Now let's analyze this strategy further. As we can see here on the option chain for these unusual options that expire April 17, we can see here that at the 75 strike puts, those 10,000 contracts are now opened. And so we know those were new opening trades. And we can see here also at the 85 strike calls, the 10,000 contracts as well as the 95 strike calls too. And based on our analysis, they were selling the 75 strike puts to open and buying the 85 strike calls to open and selling the 95 strike calls to open. And so when we analyze this trade, we can see here on the risk profile where the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the profit loss. Note the zero break-even point. And so when the lines are below it, it is a loss. And so as the share price goes down, it becomes more negative loss. If it goes up, it becomes more positive profitable, because this is a long bullish trade. And we can confirm it on the Greeks. We have a positive delta trade instead of a negative delta, which would be a short bearish trade. And notice that this trade is hedged, and that is why this blue line is flat all the way to the $75 share price. And their break even is much lower because they sold the 75 strike puts as a cash secured put, which means they are willing to own 100 shares at this strike price. And so we multiply that out and we get $7,500 of buying power required per contract. And since we know they traded 10,000 contracts, we multiply that out and we get a total trade that required $75 million. But keep in mind, even though this is $75 million, it is still a lower chance of profit trade in comparison to the trades that we share on our website, because there's other data that we analyze to find out what trades have stronger data backing it up. And so if you want higher probability of profit trades, make sure to go to our website. We'll put a link at the top here where you can gain access to better trade ideas that have a higher chance of profit and lower risk. Because clearly what is going on with the wildfires, nobody really knows. And that is why it is higher risk. but we use position sizing to manage our risk. And so this is the way we traded it. You can see here that our position over here, POS stands for position, green means buy, and red means sell. And you can see what we did was we did not sell these 75 strike puts because it requires a lot more capital, even though it does lower the risk on this trade, but we simply use position sizing to manage our risk. And so we bought the 85 strike calls and we sold the 95 strike calls. And you can see when we analyze this trade, this is a vertical call spread that only costs $93 of debit each, but our break-even point right here, where the zero break-even line meets with the share price here, is actually about $86 a share. So the stock needs to trade above $86 by expiration for this trade to be profitable. And the likelihood of this happening is less than those unusual options over here that sold these 75 strike puts, because you can see the break-even point is all the way here at $72 a share. So the chance of this happening is a lot higher, because if the stock doesn't even move, you can see it is already going to be a profitable trade, because that blue line is above zero. And so that is the benefit of having that capital to sell those 75 strike puts to lower the risk on this trade. And you can see that the theta is a positive here. So time decay is not a risk on their trade. Time is working in their favor, whereas our trade, where we're using much less capital, has a negative theta. So time is working against our trade. So be aware of the risk with trading options. In this case, it is decaying through time. And that is why we use position sizing to manage this risk, because we spend most of our time developing option strategies for better trade ideas that we share on our website. And so if you want access to better trades with a higher chance of profit, we'll put a link to our website up here, where you can also learn option strategies that reduce risk while increasing the chance of profit. Let us know in the comments below. Do you think buying Sempra Energy stock is a wildfire investment opportunity now? As usual, please hit the like button, subscribe if you haven't. Take care and have a wonderful day.